Welcome to the Module 3 of the Master's Certificate in Technical Analysis. My name is Stu Wisson. This module is entitled Trend Concepts, and furthers a discussion that we started in Module 1 when we talked about the Dow theory and explained what trends mean. Firstly, why do we want to identify trends? What's the point? Is it a sensible thing to do and a good use of our time? Well, there's some reasons why we want to identify trends. As Dow found out, trends tend to keep on going in the same direction unless acted upon by a major force. So if we find an uptrend, we can buy some of those shares and we can hope the trend continues and the shares go up in value. Generally, it's a good thing to trade with the trend. Let the trend be your friend is one of the sayings of traders, and it's true that you can trade counter trend, and some of that depends on what timescales you want to be trading. But certainly if you go with the trend, then you're more likely to put the odds in your favor. Trends, as I said, continue until there's a major change. It's kind of like Newton's laws of motion. Objects in motion continue in a straight line until acted upon by an external force, and therefore that makes it easy to see that where the prices are going, whether they're going up or down in a downtrend, and then you can trade accordingly. Now, many people think they instinctively know when they see a trend that's not really good enough for us to put numbers on and to do technical analysis. You really have to define what you mean by trend in order that it's consistent and repeatable. So when we have an uptrend, obviously the prices are going up. We can see that on a graph. But prices don't go up in a straight line. They fidget around and move around quite a bit. There's this thing called volatility where they go up and go down for some time, but on the whole they're going up in an upward direction. You can also have a downtrend, and we have had a few of those in the past year or so. The downtrend is where the price is, in general, on average, is going down. Now that doesn't mean it goes down every day. Some days it goes up, but it doesn't come as far as it has done going down, so it generally drifts downwards. There's also a third kind of trend which people don't always think of when they think of trends, and that's called a sideways trend. Or sometimes it's called trendless. That's when the price or something is oscillating up and down within a narrow range, but the price of something isn't going up or down. It's just staying in a range of prices on a chart. It's just going through horizontally, which is why it's called a sideways trend. And that's what Dow called a line. About half the time, on average, you'll find that the share prices go in a sideways trend. So it's important to know about it. Quite often you're advised not to trade whilst this is going on. Obviously there's not so much opportunity for making a profit than you can do, but you can do various techniques if something is in a sideways trend and just going up and down within a bracket, and you can still trade that up and down. But it's not the best choice or the first choice. You'll usually want to trade within a trend that goes up or down clearly. Now we're talking about defining what we mean by a trend. For an uptrend, we define that each peak, each maximum price is going to be higher. If it peaked at £5 last week, then we expect a peak of £5.50 this week before it goes back down a little, and then it comes back up again. Also, in an uptrend, we want each trough, each low point to be higher, so we don't want it to drop back so far as time goes by. We have to have both of these things to have a good confirmed uptrend. Things don't always comply with those standards, but in that case you can say that the uptrend isn't so sound. We have a similar sort with a downtrend. In a downtrend, each peak gets lower, and each trough gets lower too. So each low point gets lower, and that gives us a good sound downtrend. We don't want to see prices fiddling around higher one week, lower the next, and then higher again, because that's actually not defined as an uptrend or indeed a downtrend. So here's an example of an uptrend. A very simple drawing. The price goes up to a peak, comes down a little bit, then goes up to another peak here, higher still, comes down, but not quite as far as the other one. Goes up again, comes down, and so on. You can get the picture, and we can say the same thing about the downtrend. Each successive peak is lower. Each successive bottom is lower, and that's a clear downtrend. No ifs and no buts. Sideways trends, or a line in Dow's terminology, goes up and down. Maybe quite a bit irregular, and that basically is it's not making any progress up or down. Now here's a bit more of a breakdown of a trend. This is an uptrend, and we can see that there's an uptrend from A to D. D is higher. B is the peak before D, and that's a little bit less, so that's okay. In an uptrend, the D has to be higher than B and C, and the low point has to be higher than A to satisfy a definition of an uptrend. Now that may sound complex, but just simply follow along and you'll see that it actually makes an awful lot of sense. But of course the price jiggles around inside that as well. We can see that the price goes from A to B and down to C and then up to D. But it doesn't just do that straight away from B to C. It goes from down from B to E, jumps up a little to F, and then goes back down to C. So we have prices going up and down, even though it's a good confirmed uptrend. You can't expect it to go up in a straight line. Now the next topic we'll talk about support and resistance. Support and resistance are levels of price. They are levels of price where the price of the stock stops moving. When the price comes down to a support level, that support level supports the price and it stops moving, and it'll go back up again. Where the price goes up to a resistance level, the price stops moving there and it'll come back down. Here's a demonstration of that. In an uptrend, it goes up to the resistance, hits the resistance and bounces back down and comes down to support, but not as far down because this is an uptrend. It's not as far down as where we started, and then it goes up to the resistance, and again this is higher than the previous week because it's an uptrend, and back down to support, up to resistance, and so that carries on. These are lines that we can draw horizontally on a chart and say we found the support for the price there. We can do the same with the downtrend. Comes down to support, it halts, the price goes back up a little, it retraces up to resistance, comes down to support, up to resistance. So the price doesn't go in a straight line, it'll go between these levels that we identify as support and resistance. Often these price levels will occur at whole numbers. This is part of the psychology of trading, which we'll cover more in later. But the supports might be at 50 and the resistance at 55, and then the next support comes down to 40 and the next resistance back up to 50. And this is something we see regularly in technical analysis. It's all to do with observation. It's analysis, not synthesis. So this is something we see. Technical analysis is all to do with observations. We're not technical synthesizers. We don't make things up, and we analyze what actually happens. We're basically technical analysts. So as analysts, we look at what actually happens. We don't make up what we think should happen, but we look at what does happen, and human psychology plays a big part of that, as we've seen in previous modules. And one of the factors we find is that support and resistance tends towards the whole numbers. Now here's an interesting concept, which works out quite often in practice, and that is support and resistance can reverse what they do. If in this case, for instance, we go up to a resistance, we come back down to support. It's an uptrend, so the next time it goes up past that resistance to a higher resistance. Now because it's broken through the resistance and goes above it, that resistance might very well become a support level for that price. This is an interesting concept, and it's borne out in practice that it really will become the opposite. Now if we look here on an actual chart, we can see earlier on in the chart, June, July, August, we're hitting this lower level line as a resistance level. It bounces back down, but it breaks through in August and goes up to a higher level which we now identify as the new resistance. But when it comes back down and stalls at the old resistance level, and that becomes a support. We can see it happening, and it happened again across in November and going on. In fact, there is an example of sideways trending from August through really to the end of the chart, and the price is bouncing up and down between the support and resistance at 27 and 29. So that's showing you the role reversal, but it's also showing you what a sideways trending chart looks like too. Let's go over and cover some trend lines. It's covered trending, and it's covered support and resistance in this first part, so therefore I'll see you in part 2. We're in Module 3, Part 2, which is all about trend concepts, and the second part of this course is discussing trend lines. Not surprisingly, you may understand that the trend lines are lines that follow a trend. So therefore, the first thing you must have to say is that you must have a trend, and in this respect, if it is an uptrend or a downtrend, sideways trend doesn't count. We're looking for an uptrend or a downtrend, and then we may be able to draw some trend lines, which we will have uses as will be explained. Now we can start drawing a trend line once we have 2 points. If we have an uptrend, then the 2 points will be 2 successive low points, or troughs that we see on a chart, and we can draw a straight line from one to the other, and extend it off the right to see where it goes to. But 2 points just don't make a straight line, so to make a trend line that is confirmed, and that is considered valid, we need to have 3 points that we can connect with a straight line, and again, these are the low points of the chart. So it looks like this in simple form. The price is the jagged line, and the trend line is the straight line, running and touching along those 3 points as previously mentioned. That is therefore a confirmed straight line trend line, running and going upward. The same thing applies when we have a downtrend. So in this case, we put the line across the peaks. So each successive lower peak, you can draw a line connecting them. If you draw a line, so that's a confirmed down trend line. Now, you won't always be able to do this. You may not find that the peaks or the troughs line up with the straight line, and that's okay, because prices will do what they will. But you will find that quite often, more than you would like, you would be able to draw a trend line. And if you can find that, it's very useful, because when you'll be able to draw a trend line, you would then expect the subsequent low points in the case of an uptrend, or peaks in the case of a downtrend, to stop when they get to that trend line. The meaning of the trend line is that this is the angle that the price is going up, or going down at, and having the line projected out to the right for the future. It gives us a point where we'd expect that price will stop. Now, that also gives us a further confirmation that the trend line is valid. It makes it a stronger trend line. If a trend line we would rely on, well, basically it makes a trend line that we would rely on more, because if the price does stop on the trend line, then that's another point saying that this is a sound line, that people are watching that, and that the price is not going to go beyond that. And if it doesn't stop at the trend line, and that's significant too, because this suggests that the trend is failing. And if a trend is failing, then that gives us a message, if we're trading with the trend, that perhaps we want to pull out at this point. Perhaps we want to be long on an uptrend, or perhaps we're thinking that the price is going to start to go down now, and we need to sell out of our position. Now, according to this chart, as long as it isn't significant, this isn't that precise a sign, and you could get a little glitch that goes down a few percent below the line and comes back up again. And that doesn't matter as long as it doesn't go too far below, as long as it doesn't stay below. Some people say that if a price closes below, then that is important, whereas if during the day, if it goes below and comes back up again, that doesn't matter. And another guideline is if it stays below the line for a couple of days rather than just going below one day and coming back up the other, then some traders will say that the trend line is now breached and it's not holding, so we want to watch out. Of course, if it is breached, then we get to another use of the trend line, which is role reversal. Now, in the last part, we talked about the role reversal of the lines, of the support and the resistance lines. And in this example, the role reversal of the trend line means that if, for example, it's an uptrend and the trend line comes down through it, when it comes back up again, it may just stop at that trend line and treat it as a resistance. Here's an example of an actual chart. You can see a trend line is drawn on here from October of 2004, and then it starts to shoot right through the trend. Basically goes through October of 2006, and there's a middle. You can see it touches it several times, which is an example of how, in fact, a straight line can be touched like this despite any fluctuations you might think this may have. But then if you look over towards the right, about where it says January of 2006, the price has dropped through the trend line. It did that at the end of 2005, and it's come back up to challenge that in January of 2006. You can see that the shadow just goes back up a bit and touches the line, and it comes back down again. So that's an example of swapping of the role of trend line from being a support to the price to being a resistance once it has been breached. Now, trend lines aren't completely scientific. There's a formula to draw them just by joining those lowest points, but they can vary and they can draw, and they can draw redrawing quite often until you get one that's valid and one that's supported by lots of touches by the price that's bouncing off again. So don't be scared about redrawing trend lines. If you find one you started which isn't working out, it doesn't mean that there isn't a trend line there. It does mean that you can try and redraw another one. Now you can see that on this chart, in fact, there's another interesting example. From October of 2004 up to where this big black volume line is, there's a much steeper trend. And again, when we look over just about July going through to September, there is another steeper trend. So it wouldn't be wrong to draw a trend line for either of those steeper trends. You have a straight line that joins the bottom of those prices, but it would depend what you are trading. This is a long term, obviously, this is over a period of years, but if you are trading shorter periods, you might be interested in drawing that trend line at a steeper angle and trading within those times when the price is rising more quickly. Now here's an example of redrawing. The trend line started off steeply, like that chart we just looked at. It started off steeply and it was supported, and we got 3 touches. But then the price dropped through, came back up to touch the trend line, which became a resistance. But then it dropped back down, and we've got another couple of lows there, which form a straight line, which we take them back to the start of the trend. So in the long-term trend, we have a lower angle, and if you're looking to trade this, you would want to redraw from the higher angle line because that's not applicable anymore. So we need to form that lower angle and trade from that. This is something called a trend line fan. It's kind of clever. You have your first steep trend line, which is confirmed. It has 3 touches. Then the price drops down through it and comes back up to it as a resistance. Now what you do is draw another trend line from the start of the trend line to the low point just below. And that forms another trend line, which then starts to build up the fan, which may or may not get broken, as it is in this example. And that becomes a resistance again, but you could draw several lines fanning out like that and deduce certain things from that. So that's the end of this section on drawing trend lines. In the next part we'll talk about channels, and we'll talk about a few other types of lines that we can draw on charts that may provide support and resistance locations for the prices. So I look forward to speaking to you then.